So what I want to talk to you about today is value investing in a world of indexation. And I want to start off by the simple premise that we all like free stuff. All of us love free stuff. And perpetual motion machines promise free energy. So it's no surprise that fraudsters through the ages have always come up with some sort of idea for a perpetual motion machine to sell free energy to people or to sell their stuff to people. They just use it as a decoy to sell whatever they want to sell to people, because people want this free stuff that perpetual motion machines promise. One of these fraudsters in the late 19th century was a guy by the name of John Keeley, who announced his new perpetual motion machine in 1872. He called it, he incorporated his company called the Keeley Motor Machine in 1874, and he alleged that this machine that he invented could generate enough energy from a quart of water to power a train from New York to San Francisco and back, 8,000 kilometers. That was his premise that he promised, that he held out to investors in his company. Amongst other things, he called his invention a hydro-pneumatic pulsating vacuum engine. He also called it an etheric force machine. And his use of the scientific jargon, of course, gave him the appearance of a sophisticated scientist. Of course, later on, after his death, people found out that this machine was actually was compelled by compressed air under the floorboards of where it stood. So it was a complete fraud. But of course, this being America, Keeley used this machine to sell stock in his company to the public. And this stock eventually ended up. Which brings me directly to value investing. In the past, value investors used to trawl the market looking for undervalued situations, companies that were priced by the market below the intrinsic value because of possible management missteps, cyclical headwinds, difficult business combinations. Those sort of events would trigger an undervaluation, and the value investor would then do their calculations, do their sums, and buy the stock. And if they're smart and ahead of the market would follow them and then price the stock up to its intrinsic value. This is a process called mean reversion. Stocks revert to their mean value over time. They also did this on the short side by identifying overvalued situations, selling them short, and then after a while the market would agree with them and sell down these companies to their value. Also mean reversion. Famed value investor Jeremy Grantham of GMO called mean reversion one of the strongest effects in financial markets. And this was all based on Ben Graham's original book, Security Analysis, published in 1930. Fast forward 100 years, and value investing is out of favor, firmly out of favor. The investing story driving the market has been polished to a bright sheen. Doesn't the Magnificent Seven sound so much better, more comfortable, and more investable than the fags? One of the few surviving value investors globally, David Einhorn, has publicly stated that he had to change his investment process because markets are broken. Jim Chanos, the famous short seller, closed his hedge fund last year and said, and I quote, "It's no secret that the long-short equity business model has come under pressure and interest in fundamental stock pickers has waned." Even Grantham threw in the towel on profit margin mean reversion, citing permanently elevated profit margins due to globalization, corporate political power, and very importantly, low interest rates. So what's going on here? Why is value investing no longer working as it worked for 100 years? One of the reasons is the rise of indexing. But make no mistake, for most investors, indexing makes a lot of sense. Provides market returns at a very low cost. In the USA, at least, the market has been a great place to be. S&P 500 has compounded over the last 70-odd years at just over 10% per annum. That means your money doubles in value every 7 years. That is a fantastic return, especially given that inflation in the US over the past 7 years has been around 4%, which means in real terms, your money, if it was invested in the S&P 500, grew by 6% per annum in real terms. That's huge. No thought, no work, no research, no special insights required. Just patience. All you need, just patience. On top of that, according to Morningstar, 74% of US large cap fund managers have underperformed over the past year, underperformed the S&P 500 over the past year. And in the decade ending 2023, in the past 10 years, 90% of US large cap managers have underperformed. Given these numbers, indexing is not only sensible, it is compelling. So it should come as no surprise that money is flying into index products and out of active management. In fact, last year in 2023, the amount of money managed by passive funds has exceeded that of the amount of money managed by active funds for the first time ever. Last year alone, Morningstar reports that passive US equity funds took in $244 billion, while active funds suffered outflows of $257 billion US. These are huge movements, and they've been accelerating since 2008, since the Great Financial Crisis. It started then, and it has been accelerating every year since then. Now, here's the crux of the story. Active managers as a group are overweight the smaller, undervalued stocks. And so they overweight the smaller, undervalued stocks and underweight the bigger stocks in the index. So, and Patrick Palfrey of UBS says, active large cap managers have a natural propensity to underweight the bigger stocks because those are the most popular stocks and the value is to be found in the smaller stocks. It's generally always the case. So what happens with these flows? As money flows from active managers to passive funds, the active managers have to sell what they own. They are forced sellers of the smaller, undervalued stocks. Not because they think these things are expensive or bad companies or bad investments. They are forced to sell it because the money is being taken away from the active managers and put in the hands of the indices. And what do the index managers do? They buy mainly the big stocks because that makes up the bulk of the index. So undervalued stocks, smaller undervalued stocks face a wave of continuous selling and big stocks face a wave of continuous buying. So today the indices have become quite concentrated as a result. Magnificent Seven now make up 30%, over 30% of the S&P 500, and US stocks make up over 60% of the MSCI World. So just those 7 big stocks dominate even global indices today. You can't get away from them. And as these concentrated indices continue to outperform, they attract more money, leading to further concentration and further outperformance. And the narrative gets stronger with every iteration. But that's all it is. It's a narrative. Because no one really knows what the earnings power of these Magnificent Seven companies will be 10 years from now. It's just like a perpetual motion machine. Let me show you why. In 2015, Microsoft was in a P of 15 and Apple was in a P of 10. These companies were regarded as dinosaurs. Nobody wanted to own them. I know because we owned them in the Value and Recent Global Value Fund at that time. Nobody wanted to own these stocks. It's only after that that the iPhone, that the cloud, that the AI now has driven the earnings of these companies to very high levels and made them very popular. But if you looked at analyst reports in 2013, 2014, 2015, nobody mentioned these items. Nobody mentioned these driving forces of earnings going forward. They were unforecastable. Nobody knew about those things. Today, the Magnificent Seven, Apple, Microsoft, NVIDIA, and all the rest, trade on an average P of 48 times in trailing earnings. They are seen as must-haves in any portfolio, and analysts all forecast a very bright future for these companies. So there's 2 questions you have to ask yourself when thinking about these stocks and indices in general. Why were analysts wrong in 2015? And are they right today? Need to be able to answer these questions. My answer is simply that the future is unpredictable, and when you pay a high price for a stock or an index, you are assuming, no, you are demanding a rosy future. You might find it comfortable to do so because all the analyst projections are so rosy, predicting exactly that rosy outcome. But my view is that their predictions are not worth it. What drives returns? There are a lot of numbers, a lot of factors that drive returns. Narrative is one, and we've spoken about that. But the fundamentals that drive returns, some of which are the following. First of all, size matters. Since 1957, biggest 10 stocks have underperformed an equally weighted index of American stocks by 2.4% per annum. Will it be different in the future? Since 2013, big stocks have actually outperformed the index by 5% per annum over the past 10 years. Just like in the 10 years leading up to 2001, big stocks outperformed. In the 7 years leading up to 1974, big stocks outperformed. History doesn't repeat, but it does rhyme. But right now, the market thinks that outperformance of large cap stocks will continue, despite 7 years of history. I mean, 10 years feels like a long time, but in the broad sweep of history, it's a very short. So that's the first thing. Size matters. Second thing is starting valuations matter. But Microsoft's net income over the past 12 months was $72 billion. Depreciation and amortization was roughly $13, $14 billion. So cash from operations was around $87 billion. Actual capex was $35 billion. Remember, NVIDIA's revenue is Microsoft's and Google's and Meta's capex. Microsoft's capex was $35 billion, although the income statement is a D&A, depreciation and amortization, is only $14 billion. Capex $35 billion, leaving owners' earnings, cash flow minus capex, at just over $54 billion. Accounting earnings of $72 billion translates into about $10 earnings per share, putting on a P of 40. But on owners' earnings, multiple is 55 times. And this is a company that has grown its net income, accounting earnings by 12% per annum, and owner earnings by a much lower percentage because the capex has consistently been higher than depreciation and amortization. So you're starting with a free cash flow yield of 1.5% on Microsoft. Now I can go through all the other stocks, they're all very similar. What can we take from this? Markets tend to ignore the immutable laws of economics and finance when the price of an asset goes up a lot. If you're raking in the money on an investment, why question its merit? So here's my solution to this problem of value investing in the world, trying to avoid the expenses. So instead of trying to look for business with solid fundamentals, buying them in the hope that the market will mean revert them to their fair value, I'd rather buy shares that have the following characteristics. Number one, they need to be small, in other words, ignored or subject to forced selling by the market. Number two, they need to be a good business. They need to be a business that generates solid earnings. And luckily, you can get small companies with solid fundamentals because they're being sold, they're being forced sold. You know, they're not being sold because there's something wrong with it. And thirdly, you want a management team that understands capital allocation, that uses the free cash flow of this business to buy back its own shares. If you can put those three things together, I think you can build a wonderful portfolio of value stocks that can actually outperform the index. If you can buy a good company on a starting PE of 5, your earnings yield is 20%. So even if this company does nothing going forward, just maintains its current earning power, you will earn 20%, which I think is a good number. And you're taking very little risk. But if the company were to also use its cash flow to buy back its shares, you can get a higher return. And that can turn into a wonderful investment. So in South Africa, I'll highlight two examples, and there's actually quite a few of them. But I'll highlight two examples. First one is Argent. Argent's shares and issues over the past 5 years, shares and issues has declined by 33%. They've bought back a third of their shares over the past 5 years. The earnings per share 5 years ago was R1 a share. Today it's R5 a share. They've grown the earnings per share faster than Microsoft because they've bought back their shares. Yet, today the shares trading on a 17, 18 Rand price, which puts on a PE multiple of just over 3 times. That's a 30% return just if it maintains its current earnings power. By the way, the share price has gone up. If I had slides, I could show this to you, but we're not allowed to have slides, so you can't see this, but I'll tell you that the share price has gone up from 6 Rand to 18 Rand over the past 5 years. Another one, Calgro M3, which is a builder of houses, low-cost housing. It's bought back 25% of its shares over the past 5 years. Its earnings per share 4 years ago was 15 cents a share. That was a cyclical low point, though. Today, they estimate that the earnings will be R1.84. That's more than 10 times growth in earnings per share over the past 5 years because business has gotten better and they bought back a lot of shares. Today, the share price of Calgro is R4. You're paying a P of 2 times, just over 2 times. That's a 50% return if you do nothing. So it's no longer good enough for value investors just to do their research, identify cheap stocks and rely on the market to re-rate them. You have to buy stocks that are looking out for themselves, that are acting against this wall of money leaving the market and force selling them by buying back their own shares. I'm going to end off with the valuation case against index. You know the old Irish joke about the tourist who gets lost in Ireland and asks the local Irishman for directions. And the Irishman says, well, if you want to get there, you probably don't want to start here. And we're at a similar place when it comes to indexing. The Magnificent Seven now makes up over 30% of the S&P 500, and US stocks make up over 60% of the world, MSCI World, as I said. Overvalued assets like Microsoft now play a dominant role in all these. My advice, if you want good returns, don't start with the index. You have to do something very, very different. I know this advice flies in the face of your lived experience over the past 10 to 15 years. But things always feel pretty good at the top of a bull market, as we've seen. As Warren Buffett likes to put it, bull markets are like sex. It feels best at the very end. And that's where I'm going to end this talk. Thank you very much.